Currency risk management, translation exposure. So in this session, we'll mainly answer some of the questions we raise, which is basically what is translation exposure, when translation exposure is measured, when does a firm experience translation exposure, why is translation exposure also called as accounting exposure? So the first question is, what is translation exposure? Also called as accounting exposure or balance sheet exposure, translation exposure is the restatement of foreign currency financial statements in terms of a reporting currency, and this exposure is there because of a periodic need to report consolidated operations of a firm that may be worldwide, reporting in one reporting currency. So this process also gives out the financial position of a group having foreign subsidiaries in the reporting currency, which might be the local currency from where a group of companies may function. So that is what is translation exposure. Now let us see when translation exposure is measured. Translation exposure of a group is measured when translating the financial statement of its foreign subsidiary into local currency or reporting currency for reporting purposes. It is highly indicative of the possibility of gains or losses as a result of the translations that are effective for converting as per an exchange rate of the foreign operations of a group. Due to such translations of foreign operations of a group or a foreign subsidiary, the gains or losses may be reversed in future accounting periods, but do not represent realized cash flow unless and until the group is liquidated in whole or in part, or the assets and liabilities of the group settled in the long term. So that is when translation exposure is measured. Now, typically these translations do not require management action unless the management believes that translation losses or gains affect the materiality or value of a firm or business, in which case it always referred to the international accounting standards for setting out as the best practice to be followed. So these translations also do not require management action unless certain covenants exist in the deal being formed by the group's foreign subsidiaries. For example, gearing profiles in a loan agreement that may be breached as a result of the translations to a domestic currency position. Now, when does a firm experience translation exposure? A firm experiences or is subjected to a translation exposure when it has subsidiaries or assets in a foreign country. Translation exposure happens as a result of the consequence of the fact that a parent company must consolidate all of its operations, including operations of its foreign subsidiaries, into its own financial statements in a reporting currency, which most likely is the local currency of the parent firm. Now, lastly, why is translation exposure also called as accounting exposure? Fluctuating exchange ratios or rates that may result in losses or gains during the translation process, and as a result, this type of exposures will immediately relate to balance sheets, assets and liabilities. One reason why this type of exposure is also called as accounting exposure. Now let us do an illustration of translation exposure. So for illustration purpose, let us consider a US company that has a Mexican subsidiary, and the subsidiary buys an asset for 12 million pesos. Considering the inflation rate of Mexico to be 50% and that of US to be 0%, hypothetically, and considering the purchasing parity holds, the exchange rate for 1 year is considered 18 pesos per USD. Write the methods of proper translation or exposure. So here there are a few factors we have to consider. One is we can do this on the basis of a historical exchange rate, and we can do it on the basis of current exchange rate. So what is current exchange rate here? It is 18 pesos per USD. what might be the historical exchange rate considering the inflation rate of 50% or not? It might be much lesser. So in the case of historical exchange rate, we do not take into account maybe the inflation rate. So it is kept at 12 pesos per USD. So translating historical cost of 12 million pesos at historical exchange rate at the time of acquisition, that is 12 pesos per USD is the historical exchange rate. The USD dollar equivalent of the asset is valued at 12 million divided by 12, which is 1 million USD. That is the historical exchange rate. Now, what is the current exchange rate or the translation as per current exchange rate? Considering Mexico as a country that utilizes inflation adjusted or current accounting system, the assets indexed will be adjusted to 18,000 pesos. Why it is not 18,000? It is 18 million pesos. Why it is 18 million pesos? It is because of inflation rate 150% because of inflation of 50%. And translated using current exchange rate of 18 pesos per USD yields 18 million divided by 18, which is again 1 million USD. So hence it is to be surmised that for proper translation of value, we should either use the current exchange rate with current accounting practices, or we should use the historical exchange rate with historical cost accounting. So that is the illustration on translation exposure. Illustration of translation exposure. Next, we are trying to measure translation exposure. So in short, the translation exposure measures the after effects of an exchange rate on published financial statements of a firm, where we consider the translations based on assets and liabilities held by a firm in its balance sheet. So for that purpose, we say what remains unexposed. So what remains unexposed are assets and liabilities that are translated at historical exchange rate. And what remains exposed are assets and liabilities that are translated at current exchange rate. And this gives way to our definition that translation exposure will be the difference between exposed assets and exposed liabilities. So it is actually the difference between exposed assets and exposed liabilities. So this sums up a session on currency risk management, translation exposure. Thank you.